Good afternoon, everyone. Brett Crowther with you. Good to be back teaching a webcast. It's been a while. For those of you who don't know me, I've been around for quite a while teaching these, working at Charles Schwab or other companies that got acquired by Charles Schwab. I've actually been with the company doing this for about 21, a little over 21 years, in fact. So, I've spent a lot of it teaching all kinds of classes, did the workshops on the road, help out in a lot of different factors. And it's just good to be back teaching webcasts. Been wanting to do this for a while and now have the opportunity back. So good to be with you. We're going to be covering short verticals. I'm going to be taking this class moving forward. So please join me each and every week. I have a lot of good stuff to cover. In fact, today we're going to be talking about the importance of volatility. You know, when you're looking at those short verticals, we're right in the middle of earnings. We're right at the start of earnings. And so we need to understand the impact that earnings and volatility can have on those trades to help us make better informed decisions. And so we'll get into that here in just a moment. But first, let me cover some important disclosures and things that we need to understand. And by the way, you can also follow me on X. You can follow me at Brett.Crowther at CS, or Brett Crowther CS, not dot, sorry, but Brett Crowther CS on X. And, I post some comments out there. It's a good way to keep in touch in between our classes. So, go out there and give me a follow on that and we can keep in touch that way. I just want to say hi to a lot of people out there that I've been in the backgrounds with for a long time. You probably see me on the chats. Really been in management for the last 7-8 years. And I've been filling in here and there in chat and some other areas that are needed. The Schwab Network, which is a separate but affiliated, the Schwab Network, a separate but affiliated company. I'll do hits on that. In fact, I have one tomorrow morning at 6 a.m. Mountain Time. So I got to get up and get going at 5 a.m. to get prepared for that. Be an early morning, but I fill in on other areas in the market or in the business that are needed. And but now I get to share my time with you. So that's great. All right, let's cover some disclosures here. Just remember that when we talk about options, what we talk about is not a recommendation, but for illustrative purposes only. When we talk about stop loss orders, not a guarantee that they're going to activate at those prices. They can be triggered and filled at different spots. And nothing we talk about sorry, I missed one here. It's all for educational purposes only. Not a recommendation. We are using paper money. It is for educational purposes only. And also understand that short options can be assigned at any time, regardless whether they're in or out of the money. All right. So with that, now in past performance may not be, not indicative of future performance, right? Got to get that one in as well. So let me actually go out to the chart. I'll cover the agenda here. Really, I want to go out and talk about, what's going on in the market. And then we're going to look at price, time, and volatility, really focusing on that volatility. We're going to look at some of the Greeks, how it impacts the change of the price of the options, and use that to help us determine, how can we fine tune some of these entry points. And then we'll also look at some stocks and look to play some trades to wrap it all up in a little bit here. Okay, so let's talk about the market first off. So generally speaking, when we're looking to trade options, like short verticals, whether it be a bull put spread or long or short put spread, I should say. When we do that, we are looking, generally speaking, for bullish, semi-bullish to upward trending stocks. It's nice to have the market go in our direction, or direction of the stock, because generally speaking, a lot of stocks will go in the direction of the market. And so that's why we often give a look and see what's going on in the market. And if we look at the SPX, we can see here that the SPX, has had it's been strong. It's been climbing, right? We have our 30-period moving average along here, and it's been bouncing along that, heading up. Let's zoom in on this a little bit more, kind of jump in on this. It has hit a little bit of resistance right back here in early October. It fell down and then has since climbed back up to that area. So it's kind of sitting at this area of resistance where, it might find a little bit of, this is where you could expect possibly a challenge, climbing higher. I mean, just right there right now. So the expectation is a trend until otherwise, right? And it's been a bullish trend. And so the expectation is it would break the old high simply like, back, whoops, let me draw this in right here. Like there was an old high here, there was an old high here, there was an old high here. And each time, it broke the trend, ran up and pulled back, broke it, ran up and pulled back, broke it, ran up and pulled back. And so that's the expectation. Doesn't mean it has to do that, but that's what we're going to be, expecting it to do. And if that's the case, if that, trend does continue, but we'll keep an eye out if it doesn't, if it does continue, then we look for something that's a little bit more bullish, right? So just kind of keep that in mind in our back pocket there. So, lots of, as we look at that also, we can look at not just the SPX, but we can look at some of the other indices as well. We go over to the Dow. What do we see there? Not surprising, a very similar setup, right? Where it ran up, hit its high, the high came back, ran back up. Now this one's pulled back just a little bit more. And so we've had just a little bit of a pullback here. It's not sitting right at that resistance like the S&P 500 was, but still overall, bullish pressure is what we're seeing here. And so if we look at the NASDAQ, the NASDAQ's been interesting. In fact, maybe sometime I'll take some time and talk about these Fibonacci's and retracements, projections, and all that to help us as we talk about kind of identifying potential price movements. But this has had a pretty good run. And once again, it's kind of right up against that resistance that made all three of them to a certain extent have run up, hit that high back in early October, pulled back, run up, hit it again, and pulled back slightly from there and seemed to be rebounding. I mean, excuse me, it's been a good day. It's been more of a bullish day today, right? So far, day's not over. Still have a couple hours in it. We'll see what happens with that. But overall, upward moment. I've got a couple things saying, hey, looks like a false breakout, right? Well, could be. We just sell some calls today. Says Bruce. Yeah, we'll look into that. We'll look into that. Hang tight. We're going to look into that throughout this session. Okay. Riceberg, good to see you. Met him in Houston, which, by the way, real quick, I've been around the country helping out the workshops, filling in when we need help there. And so I met several of you out at a workshop. And if I go out to another one, I will, probably not the rest of this year, but into next year, I'll be back at some workshops. And please, if you are at one, please come say hi. I always love meeting people that, I have relationships with people I've been talking to and working with for over a decade, so it's been a lot of fun. All right. Okay, so what I want to do, though, is I want to look at just kind of breaking this down. I thought, how do I start the series? As I come back into teaching webcast and I take over the short verticals webcast, where should I approach it? I really was thinking, hey, I want to start from ground zero. I want to start from, what is a short vertical, whether it be a long call spread, or sorry, a short call spread or a short put spread, and then build from there. But I thought, gosh, you know what? We're right at the beginning of earnings season. And as I was looking through the market and just kind of seeing what's out there, what's setting up, what we should talk about, it was just, there's too much going on with earnings and volatility that if we don't understand the importance of volatility and how it impacts these options, then we're putting ourselves at a dramatic disadvantage. And so that's where we need to start, is looking at option volatility. And so let's talk about something for just a minute, because in teaching this stuff for decades, what I've learned is that sometimes we miss a few things, okay? So the first thing, when we're looking at an option, we're looking at, what drives an option? What are the three things that make a big move on the option? Or what are the three things that impact the options? Anyone tell me there? Let me know, and it's going to take just a minute to pop up on my side, but we'll see. But anyhow, it's price, time, and volatility. Those are the three major components that move the option. Now there's some other things in there as well, but that's really it. I mean, when I talk about other things, there's you can get into gamma, which is moving to the delta and stuff like that. But basically, it's price, time, and volatility. You got it, Kevin, right there. Price, time, and volatility. So let's look at this. Let's talk about price. Let's talk about time. And if we're going to type this, I got to move my cursor so I can see what I'm typing here. Time and volatility. I get it right, volatility. Okay. Now, if we're talking about price, this is a component that moves the option, right? What moves that? What actually changes that in the option? Yeah, it's stock movement, right? the stock movement is really what's changing the price. So the price of the option is basically that component is coming from what is happening with the stock. Is it going up and is it coming down? And so that will be a part of it. Now, time. What happens with time? Well, time, what directs time is just simply father time, right? Meaning time just erodes away. Options have an expiration, and every day we get closer and closer to that expiration. I haven't found a way to go back in time yet. So really, it's just going back in time, or forward in time. I was getting a song in my head in there, which Ben would like. But just time, and it erodes away at those option prices, right? And so as an option buyer, that can be to our detriment, but to an option seller, that can work in our favor, and we'll look at that. But then the last one is volatility. And what is volatility? Volatility on options is a little bit different from what it is on the stock. But what it really comes down to is demand for options. And I want to put this demand for options with a capital S, right? Capital S. And why do I say it? Because this is where I find some confusion, some misunderstanding, and I just really want to make sure we're all on the same page on this. And so please, be with me here as we go over what we're talking about with demand for options. Okay. So what happens? Demand, think about demand is just simply, what happens in general when there is demand for something. Do prices go up or down when there's generally a rise in demand? And as you know, prices go up when there is an increase in demand, right? Generally speaking. There's other factors, and we're just talking as a general concept. On the flip side, when demand decreases, prices tend to come down. And so options work that same way. All right. So rising demand tends to increase option prices, right? And likewise, we start with an F, falling demand. And I'll put this just remember, tends to decrease option prices or values, right? Now, here's the key component of this. It's not just options as calls. It's options as calls and puts. And so what I mean by this is when demand is increasing, calls will tend to go up. That volatility will go up for calls. And as volatility goes up for demand for puts, it also rises in price. And so this is something completely separate from the stock movement. The option value can actually change even if the stock is not moving anywhere. The option can change value based upon what's happening on the back end, on demand for options, right? And a good way to explain this really is coming into an earnings announcement. When you come into an earnings announcement, this is where maybe there's large corporations or us, people that just own stock, and we want to maybe protect that stock through an earnings announcement. So we go out and buy a put. Now, if we go out and buy a put, did we change the demand for the stock? The answer obviously is no. There's no buy or sell the stock. There's no change in the stock. However, there was an increase in demand for the option. And when there are thousands and thousands and thousands of purchase orders put on the options, well, that's an increase in demand. Even though it's a put, the demand will go up. So the value of the puts and the calls, just generally options, tends to go up when we see that, right? And so, so just keep in mind that we're talking about calls and puts. Follow that, right? Calls and puts, not just calls or not just puts, but just when we look for a rise in demand, we're talking about rising prices for calls and puts. Now, one thing we got to keep in mind also is that there's two ways this plays out. So as a buyer, we want prices. We want prices to rise so we can sell at a higher price, right? I don't want to go over. Okay, that's how it works. And then as a seller, we want price to decline to buy back even at a lower price. Okay, so let's keep that in mind. As an option buyer, we want prices to increase. As an option seller, we want prices to decrease. And so if we kind of put all this together, with, if we're an option seller, which we would be as we're doing short verticals, we're primarily an option seller, then we want volatility to be high and we want it to decline after we get in. All right. So let's go out. Let's take a look at some of these things out there on the market. And when we're looking at, let me pull up a couple stocks we'll look at. So let me look at, did I get that? Didn't come up. Come on, short birds. Oh, there we go. Okay, here, let's see this one. Okay, and I'm going to add something to it. So right now I just have a chart with the volume and a MACD, and I'm going to go up here to our gear up in the top along here, and I want to bring up the study set. I want to do imp or implied volatility. I want to add this study to our graph, and so I'm going to put that on there, create ads, or hit add selected study and apply, and there we go. We got the implied volatility on there, right? A question came up just a little bit ago. It just said, wouldn't you sell the put if you're long the stock? The idea behind that protection, like buying a protected put, would be you buy the put. And so basically you're long the stock, and so you expect the stock to go up. But if the stock were to drop down, then you would buy the put. So the put would increase in value as the stock drops, therefore potentially offsetting, some of those losses on the stock is kind of the idea behind that, Bruce. Selling the put entails holding cash equal to the requirement to buy the stock. Creating short vertical defines. Okay, sorry, that's Ben responding to that. Thank you. Okay, just want to make sure I'm covering some of the questions that came up in there. All right, so we have Stride here, and really any stock that I bring up, it's just for educational purposes only. It's not saying this is something to trade. We're just looking at this, right? And one thing that we'll see here is that there's earnings coming up here shortly, and I'm going to bring this up, just maximize this quite a bit, just so we can see the implied volatility. And so what this is telling us is there's demand for options, and then right here we see it kind of declining, all right? Now, generally speaking, what we'll see is demand will climb going up into the earnings, because that's where demand tends to be the highest. And then after the earnings come out, because we're expecting possibly a big move at earnings, or just something erratic or something kind of abnormal, right? Can often happen at an earnings announcement. And so we expect it to kind of rise going into that. But then when it comes out, when the news is known, then the market kind of calms down, and that demand drops significantly. In fact, look at this. We went here from 62 all the way down to a 28. And so you look at how that dropped right as that earnings came out. Now, that is demand for options drop. Now, what happened to the stock? Well, the stock jumped. It actually had a gap. It really popped up there. In fact, let me just draw a marker around it so we can see where it really popped up right here, from where it was down here, right? So, and then we got a big drop on the implied volatility. And notice how these tend to line up. We have this implied volatility. In fact, let me grab a different arrow that will help us kind of draw that out a little bit better. So right there's the drop. Earnings comes out. This one jumped again. Implied volatility dropped right after that. But going into that, it climbed. Now, that doesn't mean that it has to climb all the time. There are times where the stock can go up and volatility can go up. We saw that right here. You can see there's some spots there. But generally speaking, what we tend to see is that volatility will climb as the stock goes down, right? That just, again, nothing is 100%, but these are the general trends. So we see it rise going into that earnings announcement, and then it drops back down as a typical rule of thumb. Now, let's take a look at this. Let's kind of quantify how impactful this can be. And this is what I was talking about, is if we're looking to capitalize, or if we don't know this, it's going to really hurt us. And so what I want to do is go over to the trade tab. Let me get off the drawing tools. We can go over to the trade tab. And then from the trade tab, what I want to do is go out and let's delete all this. Let's go out and look at something. Let's look at this call, for instance, okay? So here is, we're looking at November 21. This is about 29 days away. We have this call, and we're going to look at the 150 call right here. And what I want to do is kind of look at let's see. I don't like the bid-ask spread on that. It's kind of wide, but we'll take it though. It's $12 is kind of the middle of that, right? So let's punch that in here. Let's come out here and say, okay, the middle, the mark is $12 on that call. All right. So I want to keep that in mind. And what I want to do is I'm going to come up, and I already have it up here, but I had Theo Price Mark selected from the option selection here. And from there, when I click on that, it's going to bring up this over here. And if I click on this, it tells us, just some values. And we can go in there and play with those values and see what will happen on kind of a what if scenario, right? And so if we look at this, it's bouncing around. It was at 12, 12.05. Of course, the stock is moving. And so as we know, if the stock goes up, like if we adjust the stock price, if the stock were to go up, let's add, come on, let me highlight that. Let's add $1 here. Then now it went from $12 to $12.65 if we're looking at the 150 strike, right? So we can see the impact of the stock movement on that. But what I want to do is kind of keep that, let's isolate that and leave the stock movement out of it and just say, okay, let's talk about implied volatility. Now, looking back at the chart, we had a drop in here from 63 down to 29. So roughly 30 points, we'll say, right? A 30-point drop in that implied volatility. Now, I just want to give an example of how that can impact the option play, all right, or the price of an option. So again, I'm going to come back up here. We're going to look at this and say, okay, let's come down to where it says volatility. And this time, we're going to take that down by 30 points. And so if I calculate that, let's see what happens here. Well, we remember the price was $12. So we're looking at this 150. Where does that put it? $7. That was the impact. Stock did not move in this example. Stock did not move. That was just a big drop in implied volatility. And so we saw a huge, almost, what is that, 40% drop in the value of the option because demand was drying up for that. So just it's important to understand the impact that can have. Now, that's a significant move. Right? That's a significant move. And I'm kind of exaggerating it. I'm taking, an earnings announcement that can happen. But I want to stress what can happen. So, if we were a buyer, we bought a call there, all of a sudden, we're down 40% and the stock hasn't moved. We're thinking, what happened, right? As a seller, that'd be great. But we just have to understand these concepts. Now, I see some comments in here saying, hey, LRN has low trade volume. Agreed. This is just an example to show you, the price movement, right? So we're not looking at, why would we buy that or anything? No, nothing like that. Okay. And if the seller is long stock, they're long additional shares if they sell the put. Okay, Bruce, you must be talking about, different thing. We're not talking about selling puts to increase your position on the stock. We're just simply talking about buying a protected put. And around earnings too, another thing to keep in mind is people will speculate, right? And so they can go out and buy calls and buy puts. You might do a straddle or something where, it doesn't matter which direction the stock goes, as long as it moves far enough in a direction, a player could potentially make some money. So it's just demand for options. That's what we got to keep in mind here is demand for options is what's important. All right. And if we increase demand for options, prices tend to go up. If we decrease demand, prices tend to go down. And running into earnings, prices or options or volatility tends to ramp up. Therefore, prices tend to ramp up going into earnings. Okay. So it make it seem like, well, why don't we just buy or sell an option close to earnings? Well, the problem with that is we don't know what's going to happen with that earnings announcement, right? And if the stock moves erratically in the wrong direction, we could quickly, have a big loss on our option. And so it makes it kind of a challenge to, not that it can't be done. I'm just saying there's just that unknown. And with that element of the unknown of erratic movement, it just makes it a little more kind of a challenging play. All right. So, comment is, hey, we'll be covering some short verticals. Absolutely. But I want to set the stage. We have to understand how this plays into it, right? And so, and another thing I actually want to show you is we talk about the hit that it'll take or the impact it'll have. Remember, we talked about the price, time, and volatility. With volatility, being the major component. I'm going to take this off here. I'm just going to go to let's do delta, gamma, theta, vega, and volatility. The sensitivity of the option to that change in volatility is equal across the board. It will change depending on where strike is selected, right? And so if we look at some of these, you look at, it's 0.7 cents is we're down here in the money. And where does it get a bit larger? Well, right about here is where we see it the largest. In fact, I want to do something else. I want to come in here and I'm going to change it so that we see it a little bit more decimal points so we can kind of fine tune exactly where that is. So I'm going to go setup over to application. And then from application, I'm going to go down to display. And from there, you can see it says decimal places for Greeks. I'm going to change that to 3 and apply that. And now we can see, in fact, a little bit more. And you can see, where is it the most sensitive? Where is that theta the highest? Which option strike price is being impacted the most? Well, it's this 155, right? Well, what does that have to do with the price of stock right now? 153. Well, a little bit high, sorry. Right there, 153. Well, what is the at the money strike? It is the 155. So the at the money tends to have the highest theta. And so really it kind of looks like this. It's that, come on, come back down. This is the at the money strike. And if we go in the money, then the impact of volatility is lessened. But also if we go out of the money, it's also lessened. And so it is really where it gets hit the most is at the money. And that's why I selected that at the money strike price to show you the impact of that drop in implied volatility. And so now how can that play a role in what we're doing? Well, if we go into a short vertical and we know that volatility is high, or we got some high implied volatility, where might we really look to sell? As close to at the money as possible, because we're selling most of that premium. This is where it is the juiciest. And that's where we'll get the most premium. Now, it doesn't always line up. You can just do that perfectly, of course. Life doesn't tend to be perfect. But that is, kind of what we're looking for, right? So we want to sell when volatility is high, obviously, and then hopefully it'll drop after that and help us along the way. So let's take a look at something. Let's go out to chart again. Just look at LRCX, again, for educational purposes only. And, this one I thought was interesting in the sense that from a technical standpoint, we have a stock that's uptrending, right? You can see the trend. It's been bouncing off that moving average, maybe dipped a little bit below it where it challenged for a bit, but ran up. And then it kind of went into a symmetrical triangle. I had a hit not too long ago, and this is why all this is on here, because I kind of dressed that up for that network hit. Again, separate but affiliated company brought to us by the Schwab Media Corp. Then what we see here is that winding up, and it's starting to pop above resistance there, kind of breaking out of this triangle. And stocks don't like to be tied up for long. Like, they kind of wind up like a spring, and then they'll pop. And oftentimes that's going to be what happens when we get that earnings announcement, right? It can wind up as people become less secure, less sure about where it's going to go. Then finally the announcement comes out and makes its move. Well, this one happened to open low and then pop up, right? Now, if this closes up here, again, we still have a little bit, but if that closes up there, then we could possibly be seeing it breaking above a resistance level. And we can see that if we look at the MACD, we can look at RSI and other things as well, but it has, I'm going to get a little different item here so I can draw a little support line, or not support, but just kind of like the direction. You can see the MACD is climbing. It's still suggesting, more negative energy than positive, but it's rising, meaning it's less and less on the negative side, or we could say some bullishness is starting to come back in on this push. All right. So let's assume we want to run with this. We're going to place a potential or just a paper trade on this. And let's also look at the implied volatility down here. What are we seeing? Well, let me back out here just a little bit. I also say, got Chris Carroll saying, hey, bullish engulfing. Yeah, we got a bullish engulfing on that. All kinds of candle formations that are contributing to, the look and feel here, right? But if we look at implied volatility, here is one where it's still somewhat high, right? I mean, relatively speaking, this is something I need to cover with everyone. This is important. Give me a minute to kind of do a side note here, because if we look at this, the relative low with LRCX is, let me go back to my horizontal drawing tool. The relative lows are somewhere around here. And the relative highs, it's off the chart. But we'll just go in here. The relative highs, somewhere in here. That's kind of the range it's in, right? And so this is going to be something where on this stock, 57 is kind of the high area, and down here around 33 is a low area. So at 49, would you say we're closer to the high side or we're closer to the low side? What would you say? Yeah, we're closer to the high. Yeah, it's up there. So let's look at another one. Okay. Now this one, I'm just picking something random here. There's the last real big high. 65 is the high side, and 30 is the low side, and we're at 55. Not surprising. Probably his earnings coming up tonight. Yeah. Yeah. So this one's more on the high side as well. So basically, it's juicy, right? There's a lot more kind of implied volatility in there. Now let's look at this one. And it happens to be these are all kind of around 30 and 60, but this one, the range is 28 and it goes up to 49. Now, what I want to show here is that 48, 49, that's not as high as the 60 we saw on one of the other stocks. And this is important. This is important to understand, is that volatility is relative to the stock itself, right? There's not a spot where like, okay, 28 is low and 55 is high, something like that. Think about it this way. Let's say you have two cities, and this is an analogy. Do not read into it. Like analogy is just kind of an idea to help us understand something, right? But nothing is a perfect analogy. But we have two cities, City A and City B. And let's say in City A, the home prices range from like 900,000 on the high side to 500,000 on the low side. Okay. In City B, home prices range from 600,000 on the high side to 200,000 on the low side. All right. Now, if you're looking at a home, we're all looking at a home here, and the home value is 550,000, and we say, is that a good price for the home? Yes or no? Well, I think we can all agree it depends, right? It depends, because if we're buying that home for 550 in City A, well, you know what? That's kind of on the low side, isn't it? So that's actually, we'd say, a good price, relative to that market. But over here in City B, that's actually on the high. So it's not necessarily what is the price, but what is the price relative to its market? That's what's important. Okay. So when we're talking about implied volatility, we have to look at it relative to the stock itself. It's a very important key. All right, let's take this off. Let me get rid of all this. All right. So going back to where we were, LRCX. Okay. And so right now we're a little bit on the high side, even though we're at like 58 coming down a little bit, right? And so with that would tell us, hey, options are, somewhat juicy, but nice thing is we are past the earnings announcement. And so, that unknown is more known. So let's go over and look at this. How about we do a bullish trade here? And if the stock itself is sitting where, what's the price of stock? 147. Maybe we look to sell something just a little bit below that. And by the way, I see the comment, and don't fight the trend and whatever. Yeah, but the trend is up, and when it goes into a symmetrical triangle for a price pattern, a symmetrical triangle will tend, nothing's 100%, it tends to break out into direction of the trade. So, or not trade, direction of the trend. I'm thinking, let's go do a trade. So let's go do a paper trade in here, looking at this. And so we got the stock breaking out to the upside, and so we're going to go look and see what we have as potential plays in here, right? And so when we're looking here, we got to see how many days to sell. And, I'm not going to get into the time decay element of it right now, but generally speaking, time decay tends to wear off somewhere, in the last 30 days or something. So as we look at to sell, we want to sell enough time that we get some value, but not so long that we're tied in. And so maybe a ballpark between 20 and 50 days. Let's go with this November. This is 29 days, so roughly about 30 days, right? Let's look at that one. And then we're going to go do a bull put spread. So let's start looking here at what strike prices we can go with. Now, some people will go in and put in something like, well, they got the delta in here, which tells us kind of an approximation of what's the likelihood that the stock will end up in the money at expiration, and, it's based really upon more so on the stock movement. Another way to do that is, let me change this, and I want to actually put in probability of in the money. This is kind of a Thinkorswim exclusive, proprietary tool that it looks a little more on the volatility and incorporates that a little bit more than delta. So there'll be a discrepancy between them, but they're often somewhere in the ballpark. Like, actually, let me go back. I just want to do one thing. I just want to go back to my deltas or my Greeks and just take that back down to 2, because it's just easier to read at 2. So there we go. And so like if we're looking here, 148 is the at the money. We got a 47 on the delta, and the probability of in the money is 52. And so this would say you got approximately 47% it'll be in the money, and this says approximately 52%. Again, they're both calculations to give us kind of a general idea. Nothing's 100%, nothing's perfect, right? But so we're going to go with, we're actually going to be a little more aggressive on this and say, let's go something with this like 147. Let's give us roughly that 50, right? And so what I'm going to do is I'm going to go ahead and click on this, and we're going to hit the bid, and then I'm going to hold down my control key, and we're going to go, we can go one wide. What you can do is you can go one wide or you can go two wide. I mean, when you have dollar strike increments, there's kind of pros and cons to either way we go. But what happens sometimes is, like, if you look at the one wide, to get the same as two wide, you have to buy twice as many contracts, and so there's a higher cost in that, but then they roughly end up the same, and so you have to you can play with that back and forth. But we're just gonna go two wide on this, and two wide, this would be the mid is saying 90 cents. I'm gonna pull that back a little bit. Let's get a little bit more closer to reality, because that may not feel. Let's go somewhere around 80 cents, right? Can get 80 right there. Okay, so hopefully that'll give us a little bit more real chance at feeling. In paper money, this feels almost no matter what, but in live, money, it doesn't tend to feel quite as easily as in paper money. So if we get 80 cents here, what's our risk on this trade? Well, if it's a two wide spread, then the risk is, if the stock is below 47, we want this, remember, we're selling that 147. So that's our driver there. We want the stock to be above 147 in expiration to make the max gain and keep all this credit, right? And then if it doesn't, then we're going to protect ourselves by buying the 145. And so the risk is the difference between that, which is $2. But if it does, like if it were to go down to 140, let's say, and expire there, well, we'd lose the $2, but we'd keep the 80 cents. And so what's the risk on the trade? Well, the risk on the trade is, we can do that in our head, right? $2 minus 80 cents is going to be $1.20, right? But I'll just do that. $2 minus 80 cents is $1.20. So that's the risk that we're going to have on this trade. And so if we're looking at kind of our risk reward ratio, if we're looking at 80 cents is our reward, and the risk on that divided by $1.20 is 66%. So, that's, some will look for it to be above a certain amount, like maybe 30% or something. But we're being more aggressive on this one, really looking for the stock movement to go in the direction of this trade to help us out. And so 66%, kind of double what some will put as a minimum. Again, there's some people put a minimum at 20%, but always you can look for a certain percentage return, but nothing is perfect depending on how aggressive you want to be, right? So let's go with that. Now, I'm not going to put a stop loss on this. And some people say, hey, why don't you put a stop loss in there? You can, but really the stop is somewhat built in, right? I mean, we already have like a max loss. Of course, if it does end up between strike prices, that's a different story and stuff. We wouldn't want to let it expire in between the strikes. But my point is that we're not just selling naked, the 147. We have something in there to give us some protection. So let's go ahead and let's suppose we're doing $1,000 of risk on this trade. How much are we risking on this? What was it, $1.20, right? So let's do this. If we have $1,000 at risk and potentially losing $1.20 on this, that says we can buy 8.33 shares. So let's bump this up to 8. Whoops, wrong direction. By the way, if you ever see that go that way, green, you're doing it wrong, right? Because it should, if we're net sellers, it should be red. Okay, there we go. And we'll hit confirm and send. And what does it say? Well, we're going to sell them. We're going to look for a max profit of 640, max loss of 960, break even at 146.20. And that break even is simply the 147 minus our 80 cents, right? Because it gives us a little bit of a cushion if the stock does come down. But there we go, 146.20. We're going to go ahead and send that off, and then I'll put it. See, that got filled. Now in real life, doesn't often fill that quickly, but this one did. So there's one we'll keep an eye on. We'll look at that one coming into next week. Let's also look at one more that I want to check out, and that's going to be Adobe, ADBE. Again, just for illustrative purposes only. Now, the trend on this one, a little more to downside. See that? And so it does look like it has some resistance somewhere up in here. So I'm going to draw this in and I'm going to zoom in on this. So some resistance up in there, kind of a channel that it's kind of been going through, but running up against the resistance and rolling back over, overall downward pressure. And so and also if we look at the MACD, we see that rolling over. Now this one, if we look at the implied volatility, it's not quite as juicy, right? It's not quite as strong, where we'd ideally like it to be. But here's the thing. In the real world, as we're going out there and looking at these trades day to day, it doesn't always work out perfectly. Not every stock just sets up the way we want it. So sometimes you got to roll with it and just see. So let's look at this one. Let's say we want to sell something pretty close up here, maybe the 360. We'll sell a 360 call, and to protect ourselves, we'll buy something up above that. So therefore, it just needs to stay kind of below this area at expiration to help us make max gain. All right. So let's go over to the trade tab, and we'll go with the same time, that November 21. Let's go to the call side and see what we can get here. What if we sell the 360? And this one, you'll note, is in 5 wide strikes. So we're going to buy the 365. What does that give us? Let's move that a little bit closer to make that a little more realistic. We'll go $1.60 on that. So $1.60 credit. Now this one is a 5 wide strike, right? And so if we have $5 out there minus $1.60, that leaves us with the risk of 340. And so $1.60 divided by the risk of 340 gives us a return on risk about 47%. So still not bad when you're looking at return to risk. Of course, it all depends on what probability it is. This one has a probability of being in the money, relatively speaking, if we're looking at, depending which one you want to take, somewhere around that 34 to 38%, using these as guidelines, right? And so let's go ahead and run that one. Just looking for it to stay below or be below 360, right up in there, right by that resistance area that's been resistance for a while, over the next 29 days. So what was our risk on that one? It was 340, right? So 340, so $1,000 that we're going to put at risk, divided by the 340, and I just did 1,000 divided by $340 is 2.9. Well, 2 contracts. And so let's put on the 2 contracts on that one. Again, limit day, all that's good. We're going to go ahead and confirm and send. I'm not going to have a stop loss or anything in there. Again, looking it over, we've got a break even, max profit on this 320, max loss 680. Go ahead and send that off, and boom, there's another one that we'll follow up on as we go through the class week to week. So we'll come back and look at this. All right, now let me just kind of look over to see what questions and comments came in as I was looking, as I was going through those. All right. Let's see. Don't see. It looks like Ben was grabbing a lot of them. Thanks a lot, Ben. I really appreciate you covering those and taking care of that. But all right. So as we wrap up, I just want to say, I appreciate you joining me today. Right. We'll keep an eye on this. I hope you understood the importance of looking at that implied volatility, seeing how it can impact the movement of the stock. Understanding we want to be selling options when implied volatility is high and looking to buy back when it's low. Again, that's the ideal situation. Doesn't always work out that way, but that's what we're looking for, right? But it does impact it, and we got to be careful, especially as we're entering this earnings season, keeping an eye on what's going on with that implied volatility. So we'll follow up on these each week. Again, follow me and follow Ben on X. We hope to see you there. Again, I'll post some comments on there, and comment to this one too. Please comment to our class here. Subscribe if you haven't done so. Click that subscribe button. If you have, don't, because then it just unsubscribes you. But subscribe so you'll be notified of when new things come out. It just gives you information of when we're posting new stuff. So, hey, thank you very much for joining me. I look forward to catching you next week. All right, till then, take care. See you.